Well, there's been a lot of talk lately about whether this surge in oil, this firming dollar, and this shaky little rebound in stocks are setting gold and silver up for one more ugly reset. So in this video, we're going to separate signal from noise, and you're going to walk away feeling a whole lot clearer about what may happen next. By the way, it's Tuesday, April 14th in New York, so comment the day and the date you're watching from. And if you value this kind of breakdown, subscribe and comment John AG Best so I know you want more of it. Now on the surface, this setup looks pretty simple. Oil spikes, headlines get louder, traders get jumpy, metals wobble, the dollar starts flexing, and everybody suddenly acts like the next move is obvious. But that's usually where people get themselves in trouble because markets love to look obvious right before they do something frustrating. And that's really the point here. We've got a market that's acting emotional but not broken. We've got assets sitting near important levels, but not yet confirming the big move everybody keeps talking about. And we've got a precious metals crowd that is still broadly bullish long-term, while quietly getting nervous about what happens if this turns into a real liquidation wave. Based on recently published numbers, crude has been running hot, with benchmark prices moving up sharply through the first quarter, and the official U.S. energy data is still carrying a noticeable geopolitical premium into the current quarter. At the same time, energy inflation just re-accelerated hard, with March showing one of the biggest monthly jumps in years, especially at the gas pump. So when people say oil is driving a lot of the market action right now, that part is not crazy. If energy stays elevated, it bleeds into inflation psychology, consumer mood, transportation costs, margins, and rate expectations all at once. That is not some tiny side story. That is the story sitting under the story. But here's where I want to slow down. Rising oil does not automatically mean precious metals go straight up from here. People like to tell themselves that simple little bedtime story. Oil up, inflation fear up, gold up, silver up, end of discussion. The problem is markets are messier than that. Sometimes oil strength helps metals. Sometimes it helps the dollar first. Sometimes it scares stocks first. Sometimes it does all three in sequence and whipsaws everybody. And right now, that last possibility is the one getting my attention. Because from recent market updates, gold futures are still trading in the upper 4,000 range. Silver futures are still in the mid-70s. The S&P 500 is still hovering not far from record territory. And the Nasdaq is still sitting in that very uncomfortable area where a rally can either keep going or suddenly look like a trap in hindsight. Volatility has cooled off from last week's jump, but it has not disappeared. That's why I don't think the real question is, are markets strong? I think the real question is this rebound alive or is it just breathing? There's a difference. A real rally pulls more sectors with it, absorbs bad news, shrugs off scary headlines, and keeps marching even when sentiment gets skeptical. A bounce, on the other hand, looks energetic for a minute, pulls people back in, kisses resistance, and then leaves them standing there with a dumb look on their face, wondering why they chased it. And precious metals can get caught in that same game. Now, for the long-term metal bulls, let me be fair to you because I know some of you are not trading this thing week to week. If your core belief is that currencies keep losing purchasing power, debt keeps climbing, and hard assets still matter over the next decade, then owning metal through noise is not irrational. That is a completely different approach from active trading. You are not trying to dance with every headline. You are trying to own what you believe survives the headlines. That said, even strong long-term themes can have vicious corrections inside them. In fact, some of the strongest long-term themes produce the nastiest shakeouts because they attract the most emotional late money. Once everybody feels safe, that's usually when the market decides to test conviction. And silver is notorious for that. Silver loves drama. It doesn't just rise, it lunges. It doesn't just pull back. It falls down the stairs, gets up, and acts like nothing happened. That is why I always get nervous when people start talking about it like it only moves in one direction. The moment an asset starts sounding easy, you should assume it's about to become difficult. So let's talk about the bearish case for a minute, because ignoring it doesn't make it go away. The bearish case is not that metals are dead. The bearish case is that the dollar may not be finished. Stocks may not be as healthy as they look. And if both of those things lean the wrong way at the same time, gold and silver could get dragged lower before they become great buys again. And yes, I said dragged. Because in a cross-asset flush, people don't always sell what they hate, they sell what they can. That's the part newer investors miss. They think if there's fear in the system, gold and silver must immediately become everybody's first choice. Sometimes they do. Sometimes they become a source of liquidity first, then a refuge later. That order matters. If you get the order wrong, your timing can be awful, even if your big picture thesis ends up right. From the latest public data, the Federal Reserve is still holding rates in the mid 3% range, the broad dollar index remains elevated near recent highs, and the labor market is still adding jobs even while growth expectations have cooled. The Atlanta Fed's running estimate for first quarter growth has slipped toward the low ones. Not a collapse, just a softer backdrop. That combination can keep the dollar better bid than many metal bulls expect. Now, that doesn't mean the dollar is guaranteed to go vertical from here. Let's not get carried away. A lot of people hear firm dollar and immediately start drawing straight lines to the moon. Markets don't owe anybody a straight line. But if the dollar breaks higher while growth stays decent enough to avoid an immediate policy rescue, that can absolutely squeeze metals and equities together for a while. And that is where the oil story gets even more interesting. Because if oil keeps pushing higher, it can tighten financial conditions without the Fed even moving. It can keep inflation sticky in the public imagination. It can hit consumers. It can hit transport. It can hit margins. And if markets decide that sticky inflation means rates stay higher for longer, suddenly the same oil spike that looked bullish for metals on Monday can become part of the reason metals get smacked on Thursday. That's how these things happen. One variable changes costume halfway through the play. Now let's not skip the fresh macro context on the demand side, because that matters too. March payroll still grew by something just under 200,000. Retail sales are still running above year-ago levels, and the economy is not flashing immediate recession collapse behavior, even as the growth nowcast has cooled. That creates a weird environment where fear can rise without the full panic washout showing up right away. Markets can stay sticky, confusing, and overconfident much longer than impatient traders expect. And that, by the way, is one reason I'm careful with dramatic one-direction calls. When employment is still positive, volatility has backed off from its recent spike, and headline risk is bouncing around faster than underlying data, you can get violent back-and-forth action instead of the clean waterfall move people keep fantasizing about. So yes, a sharp correction is possible, but a grinding fakeout is possible too, and those can be even more painful because they waste time, wear out conviction, and lure traders into overtrading every little wiggle. Now let me challenge one more popular idea, because this is important. I do not think every comparison to 2008 is automatically useful. People love reaching for that analog because it was dramatic. Dollar up, everything else down, then eventually a massive opportunity. Sure, fine, there are similarities, but we are not walking into the same room with the same furniture. Volatility is nowhere near full panic mode right now. Policy rates are already much lower than that old inflation peak era, and metals are starting from a very different price structure. So I would treat that analogy as a warning light, not a blueprint. Still, the correction case is real enough that you should respect it. If gold rolls over into the mid-3s and silver revisits the low 40s, that would hurt. I'm not going to sugarcoat that and pretend it would feel fun. It would feel ugly. It would feel unfair. It would probably come with a lot of loud commentary telling you the whole metal story is over. And ironically, that is exactly the kind of emotional washout that can create a spectacular long-term entry, especially in silver. Because if silver were to drop from the mid-70s toward the low 40s, you would be looking at a move that would terrify late buyers, flush out weak hands, reset sentiment, and force everyone to rethink what they believed a week earlier. In other words, it would do what great markets often do before they set up the next huge move. But that is only one path. There's another path here, and you should not ignore it. The other path is that metals are simply digesting a monster run. The dollar fails to break in a meaningful way. Oil cools off after the fear premium fades, and this whole scary-looking setup turns into consolidation instead of collapse. That is possible too. In fact, the official U.S. energy outlook already assumes current crude strength eases later this year as supply disruptions gradually settle down. So the idea that oil must keep screaming higher forever is not some law of nature. One more thing. According to the latest publicly available positioning reports, precious metals futures are still crowded enough that you can't rule out another flush simply from traders getting too comfortable on the same side of the boat. That does not mean the bigger bull story is false. It means the path may still involve a nasty test first. Strong themes don't move in straight lines. They move in waves, they punish sloppy timing, and then they reward patience after the cleanup is done. That's why the next few sessions matter so much more than the loud opinions surrounding them. Stay sharp. This market rewards patience and punishes emotional certainty. That's why I keep coming back to levels, behavior, and confirmation. Not vibes, not tribal loyalty, not the loudest thumbnail on your screen, confirmation. If metals stop reacting badly to a firm dollar, that matters. If oil pulls back and equities still can't get traction, that matters. If stocks absorb ugly headlines and the dollar stalls, that matters. If silver starts holding dips instead of accelerating through them, that matters. The market leaves footprints. You do not need to predict the future perfectly. You need to recognize which trail is fresh. And this is where investor type becomes everything. If you are a conviction holder, your job is mostly emotional management. That sounds easy, but it isn't. You have to know what you own and why you own it. You have to avoid letting every scary swing rewrite your belief system every 3 days. And if you're successful, share your success story in the comments so others can stay motivated. If you are active, though, your job is different. Your job is capital efficiency. Your biggest enemy is not just being wrong. Your biggest enemy is wasting time in a dead zone, sitting in something that chops sideways or bleeds lower while better opportunities are developing somewhere else. That's a different sport. Same market, different sport. For active investors, there are really only a few clean responses if the ugly scenario starts to confirm. One, you can step back and hold dry powder in short-duration, interest-bearing vehicles while the market figures itself out. That is not doing nothing. That is taking risk off the table on purpose. Two, if you know what you're doing, you can use downside vehicles that rise when broad indexes fall. Not recklessly, not because you're bored, but tactically when the trend actually turns. Three, if the dollar breakout becomes undeniable, some people will choose to express that view directly through dollar-linked funds instead of forcing every trade through metals or equities. There is nothing magical about making every macro view pass through the same doorway. But patience matters, a lot, because the market loves to bait active people into moving too early. It gives them the first crack, they think the move has started, they hit the button, and then the whole thing reverses right in their face. So you cannot just have a thesis, you need a trigger. A thesis without a trigger is just an opinion with better branding. And right now, I think that's the key lesson. The setup is tense. Oil has teeth. Inflation just reminded everyone it's not gone. The Fed is not rushing to save anybody. The dollar still has enough strength to make life difficult. Growth is slowing but not imploding. Stocks are elevated. Metals are strong but crowded. That cocktail can absolutely produce one more violent reset. But it can also produce a fake scare, a sideways churn, and then a renewed move higher. That is why conviction without flexibility becomes dangerous. If I had to boil this whole thing down, I'd say it like this. Don't root for chaos. Don't assume headlines tell the whole truth. Don't confuse a great long-term asset with a guaranteed short-term win. And don't let a possible correction scare you out of the fact that, over a long enough horizon, the bigger hard asset story may still be intact. Sometimes the best buying opportunity arrives wearing a very ugly face. And sometimes the big drop everybody expects never shows up, precisely because too many people are waiting for it. That's the game. So watch oil, watch the dollar. Watch whether stocks act tired or resilient. Watch whether gold and silver start rejecting weakness or embracing it. And most of all, watch your own behavior, because the market usually hurts people emotionally before it hurts them financially. This is for educational purposes only, built to help you think more clearly about the market, not to tell you what to buy, sell, or hold. Your money is your responsibility, so slow down, do your own homework, and make decisions you can live with.